Nate Dean, welcome to the podcast. Thank you so much for being here.
Thank you so much for having me.
Yeah, we're excited to get into this. So as the title there suggests in your name, you are the infinite banking coach. And this is a concept that I've been introduced to, but I've got a lot of questions, and I'm just excited to talk to you about what infinite banking is, kind of how you and your family use it, and get into the details of that. So, can you give our listeners how do you summarize the infinite banking concept? What is it, and kind of what does it entail?
So, the simplest way to break it down is this guy named Nelson Nash years ago figured out that there was a way to properly structure a dividend paying whole life insurance policy to create your own private banking system, which is essentially your own personal line of credit that you own and control that earns interest even when you're using it for other things.
I love that summary. So that's, I mean, on a very kind of bird's eye level view, that concept of why would I want to be my own bank, I guess is the first question that I would have, is in terms of, what advantage does that serve me and my family, is in terms of owning kind of that banking process for us?
So there's a principle that we talk about and we teach, is this idea that you actually finance everything in your life, whether you're paying cash for it or not.
Mm-hmm.
That is a profound statement to so many people, but I can break it down, and it's really twofold. So in one aspect, you're always giving up interest. So when you're financing, obviously you're giving up interest because you're paying interest to the bank. But when you are saving up to pay cash and paying cash, you're giving up the interest that money could have earned if it would have been in a better environment. Now, the other side of that is you're always making payments somewhere.
Mm-hmm.
When you're financing, you're making payments to the bank. But when you are paying cash, you are making payments to yourself for a future purchase. So money has to flow no matter what. And this idea that we can create our own private banking system means that now we have an environment for money to flow to that's giving us more opportunity than we would have otherwise.
I love this idea that I've heard it kind of expressed that with infinite banking, or even just some of the other examples that people may get into with using assets as collateral, that you can get your money working in multiple places rather than just one place, right? If you're saving up your money's only accumulating there, and with inflation being what it is, value's going down while you're doing that. Whereas something like infinite banking allows your money to work in multiple places at once. Can you explain maybe in more depth for the listener what that means and how that actually works? How is it in multiple places at once?
So a whole life insurance policy is a lot like real estate. And for people who understand real estate and hate on whole life insurance, it's because they just don't understand it. So with a piece of real estate, you've got the market value of that asset. But if you have a mortgage or you have a payment that you're making on it, you're building equity inside of that asset. And the equity is the portion of the value of that asset that you actually control, that you actually own. Everything else is still owned by whoever the lender is. So with a whole life insurance policy, the death benefit on the policy is the value of the asset. That is part of your future net worth. And just like anything else that we're building for ourselves, one day it's got to pass on to somebody else. We can't take it with us.
Mm-hmm.
So the money, the pool of capital that we're building inside of the policy is the equity that we get to control, that we get to access. And so this idea that we can actually practice a process very similar to the way banks do is really mind-blowing to a lot of people. And it's one of the reasons why it's a very polarizing topic, because most people just see it for what it is, and they hear whole life insurance and they go, oh, there's no way that could be good. I mean, that's the way I used to be.
Mm-hmm.
Y'all are probably the same way. But once you dive in and understand the point that Nelson Nash was trying to get across was the control of the banking function. And that is something that no one else teaches. There's not another person in personal finance that I've ever come across outside of Nelson Nash that talks about the power of controlling the banking function. And that's what's so misunderstood by so many people is they're like, oh, I put money into a whole life insurance policy and it's just a long-term savings plan. It's going to take me a long time to use it or for it to grow or anything like that. No, you can actually utilize and start using your policy within the first month of it being active. I mean, it's not something that takes a lot of time to build and set up.
So perhaps you can kind of maybe begin breaking that down a little bit so we can bring some life to this. So with the whole life policy, as I understand it, and keep in mind that I may be speaking out of line and feel free to correct where needed, but in a whole life policy, there's various products within that, right? You have like universal, and there may be one or two other variations of whole life policies. And within those, you have a cash value and then you have a death benefit. Am I correct in that?
Yes, that's correct.
So you might have, so let's maybe use, just because it's a round number and it sounds fun for people. Let's say we have $100,000 death benefit or I want $100,000 worth of coverage. Can you walk us through what that looks like, setting up a policy and then how to execute potentially borrowing against that? And then what we still have available to us if we were to perish during that time?
So we kind of reverse engineer it because we are building out plans and strategies for people based on this idea that this is going to be a cash flow strategy. That there is going to be a death benefit that comes along with that. And if we need to solve for the need for death benefits, then we look at that. But when people are coming to us, they're not coming to us because they want more life insurance. They're coming to us because they see the value in becoming your own banker and the process and what that looks like.
Sure.
So one of the cool things that really was appealing to me, because when I learned about infinite banking in 2017, I was working at a church. My wife is an educator. We've never really had a whole lot of money. And so the fact that even with as little as we had available, that we could actually start this process, start this concept and apply it in our lives and actually benefit from it so quickly was really, it was really, kind of eye-opening. And I was like, well, if it can work for me, then it can work for just about anybody. So when we're working with someone and educating them, teaching them, but then also showing them how they could actually use this in their life, it really can be tailored to whatever your situation is. So when we're helping someone, we're kind of evaluating what they're already doing in their life and just showing them how to maximize the efficiency of their processes by applying the concept. So it's hard to say if you had $100,000 death benefit, what that would look like, because everybody's situation is going to be a little bit different. But the reason that the insurance companies will allow you to borrow portions or borrow against the cash values or the equity inside the policy is because your death benefit is the ultimate collateral for your entire system. So the insurance companies are technically allowing us to borrow against our dead self in a sense. Sure. And when we're borrowing these, we're taking these policy loans from our system. The reason why we're taking policy loans is because we want to keep pressure on our money inside of our policy to continue to grow uninterrupted, like we never touched it. So when we put money into a policy, we lock in minimum guarantees on those dollars the rest of our life. And then we can still go out and do everything else we want to do. Because when you get money, there's 4 things you can do with it. You can spend it, you can save it, you can invest it, or you can give it away. Those are the only 4 things you can do with it. Well, by putting it into your policy, you're automatically solving for the need to save it because you're locking in minimum guarantees. And then you can decide whatever else you want to do with it. If you want to spend it, you want to give it away, or you want to invest it. So solving for that need of minimum guarantees is something that's really important. And that's one thing that wealthy people understand is the power of wealth creation comes from minimum guarantees and cash flow.
What does that mean? Minimum guarantees and cash flow. What does that mean?
So when you put money into a policy, you have a guaranteed contractual rate of growth on the policy, no matter what. And as long as you're taking policy loans against the cash value and you're not actually withdrawing the cash out of the policy, that means it's never coming out of there. It's just going to continue to grow for as long as it's active, as long as you have it running. Cash flow, when I say cash flow is the power of wealth creation, cash flow is what allows us to make moves and do other things. And it's really passive cash flow is the power of wealth creation, not just cash flow in and of itself, because cash flow by itself could still be spent on all kinds of stupid stuff. But passive cash flow is really the power of wealth creation, because when you've got money coming to you that you're not having to go out and earn and work hard for and everything like that, well, now you're no longer trading time for money. And wealthy people understand how to leverage time and money more than anybody else.
Yeah, there was a great example. I was listening to a discussion here recently talking about how Elon Musk had structured his planned buy of Twitter. And the details were that he was actually leveraging the Twitter or the Tesla stock that he owns, borrowing against that to fund this what is it, $40 billion purchase or whatever it was, rather than selling. Like if he had actually sold that stock, there's a tax burden there, right? He's gonna have to sell a lot more than 40 billion to get that money because of the tax implications. So rather than sell and lose that asset and pay tax, he borrowed against it to get the money to fund this purchase. So he keeps his asset, he doesn't pay tax, and now he's got a bunch of money to buy another, we presume cash flowing type asset. Is that a fairly accurate representation of kind of what you're trying to do with infinite banking?
Yeah, so leverage is this idea that we can still maintain ownership of our asset and create more opportunity with it simultaneously.
Yep. Yeah.
So yeah, the idea that we can borrow against our cash value, which means there's no tax implications there, but also infinite banking is about certainty and control. And the control aspect of this is the fact that when you take a policy loan, you get to set up the terms however you see fit. You get to decide when and how you pay it back. So the insurance company is not going to be knocking on your door if you miss a payment 1 month because you didn't repay your policy loan. That's why I said it's very much like a line of credit. So you can send money back to it. And when you send money back to it, now that just gives you access to those dollars again. Exactly.
And if you don't pay it back, I mean, it ends up just being, like you said, you're borrowing against your future dead self. And so if you don't end up paying it back, obviously we want to pay back that loan and play honest banker, as Nelson says.
Right.
But if you don't pay it back, it just comes out of the death benefit, correct?
Right.
Yeah, if you got a $500,000 death benefit and you had a $50,000 policy loan outstanding, if something happens to you, your beneficiary still gets $450,000.
So setting this up it's important to use it. This is not a saving technique is what I'm grasping or maybe trying to make clear for everyone is like, this is legitimately an opportunity to be a bank, but not to save it at 0.1%, rather to use an exchange back and forth to make some of these investments, it sounds like.
Absolutely. So money is like a muscle. You want to put it in motion to give it strength to grow. And if you think about it this way, I'm gonna use an example that might blow some people's minds. So most people don't know how banks make money. Banks make money very much like a retail business makes money. If you walk in a hardware store to buy a hammer for $10, well, that hardware store owner probably bought that hammer for $5 and they marked it up 100% and they sold it for 10. A bank's product is money. The only way that they can make money is if we bring them money. They flip our money for a profit. So the example that I use often is if I go down to the bank with $10,000 and I say, hey, how much interest will you pay me to hold on to this money? And let's say they give me 5% interest on it. I'm like, okay, that's not terrible. I'll take 5%.
Yeah. From the bank, I'll take that all day long. Yeah, I know what you mean. Sorry.
Example.
It's jokeable. Yeah.
So I'm like, yeah, I'll take 5%. Well, inevitably, somebody's going to walk in that bank or call the same day, and they're going to say, I need a $10,000 loan. Well, the bank's like, well, we just took in $10,000. Let's loan it back out at 10%. most people would look at that equation and saying, okay, they're paying him 5%, they're earning 10%, the bank made a 5% spread on their money. But they did not make 5%. Guess how much they made?
Tell us.
100%.
Because they're getting that 10 grand back plus the 5% interest that they got.
Because they're not putting any of their money at
I was
risk.
gonna say it's not their money. Yeah.
They're using someone else's money to create value. And when you use someone else's money to create value, the rate of return has a far greater impact than if you put your own money at risk. And that idea, we take that to the infinite banking world and we go, oh, we can do the same thing with infinite banking. Like I can take a loan against my cash value, and I've done this. I can take a loan against my cash value. If someone approaches me and say, hey, I need a $10,000 business loan or something like that. If I feel like they're a good bet, then I can borrow from my policy and loan them that money. And I can do the same thing that a bank does.
Right.
And as they're paying me back, I'm sending that back to my banking system.
Right.
So my money's working much harder than it would have otherwise.
So that, to me, that suggests the importance of where you're deploying that money, right? If you're taking a loan against your policy, correct me if I'm wrong, but you don't really want to just go out and buy clothes or asset or liabilities, let's say, in the words of Robert Kiyosaki. We want to buy assets or things that are going to generate cash flow so that we can use that cash flow to pay back the loan plus interest, right?
Anytime you're taking a policy loan, you're exactly right. Anytime you're taking a policy loan, you want to have a plan on how that money's going to return. Now, that could be through investments or it could be through shifting the wind current on debt. So if I've built up enough cash value in my policy where I can actually pay off a credit card or something like that, so I can pay that credit card off, and the payment that I was making to the credit card company, now I'm going to send that back to my banking system.
Right.
So if I was paying the credit card $250 a month
plus interest,
yeah. If I was paying that to the credit card company, that's a guaranteed cost to me every month, no matter what. Even if it was 0% interest, that's still a guaranteed cost that's going out the door. And every time I send that money out the door, I'm never going to see it again. It's gone forever. But if I'm able to put it into a system and borrow against it, now I keep pressure on that money to continue to grow. And I can take that $250 a month and I can send it back to my policy. And now instead of paying 20% interest, I'm actually earning 20% interest. You've probably heard Dave Ramsey say this before. The best way, if you're paying 20% interest on a credit card, the best way to save 20% or get 20% on your money is to cut up the credit card. Be done with it. So, and that's one of the things that many people don't get, because our entire focus when it comes to money and investments is rate of return. What's the rate of return? Nobody ever really studies the volume of interest versus the rate of interest. That's one of the things that we talk about and we teach our clients. Andrew, you might be familiar with this example, but in the mortgage world, and I actually have a personal story with this. So before I learned about infinite banking, I lived in a house for 7 years, and we were paycheck to paycheck. So we were making minimum payments for those 7 years. And then we sold that house. And I went back and looked at everything that I had paid for those 7 years. And you know what I discovered? 65% of the money that I paid for 7 years went to interest.
Yep. It's uncomfortable to see.
So interest is front loaded on loans. Most people don't live in houses for 30 or 40 years anymore. We live in houses 5 to 10 years and then we're moving. So if I sold that house after 7 years and I paid 65% interest, and my rate of interest on my mortgage was 3.5%, did I pay 3.5% interest? No. I paid 65% interest.
Right.
65% interest. So, and then people are moving to a new house and they're clearing the calculator on the interest and it's starting all over. So most people have an interest headwind that they don't even see, and they don't even realize that the goals that they have in life, they're never going to achieve, because they might be making, let's say they're saving 10% of their money and they're investing it. And let's say they're getting a 10% return on their money. So let's say they're earning 20% on their money overall. If they are fighting a headwind of 20 to 30% in interest, which is what the average person is actually fighting a headwind of 34.5% interest, and they have no clue.
Mm-hmm.
So if I'm at 20% and I'm fighting 34.5%, am I ever going to get past it? I'm never going to overcome that.
Mm-hmm.
So this idea that we can take this headwind, become our own banker, and actually turn it into a tailwind, and now we've got that propelling us forward, is a foreign concept to everybody.
Yeah. So this, I mean, obviously this sounds too good to be true. You're telling me that I could borrow as much as well, maybe not as much as I want. I can borrow against myself, still be making interest on the original or what the initial amount, and be borrowing that money and using it to buy other things and all this stuff. This sounds tremendous. How granular can you break this down to kind of bring this to reality? Because I think, because this is such, I don't want to say obscure as in like an odd idea, but this is not like a normal thing. I didn't go to high school and learn this in my economics class. I didn't go to college and ever hear of IBC. So it's likely going to be new to everyone listening to this, or maybe they've seen it once and they're like, it's not for me. So I guess maybe my first question would be, who is it for? Is this for everyone, or is it for maybe particular people in certain stages of their life? So that would be question one. And then question two is, what would this look like for like a normal Joe Schmo?
So my first thought when you said a normal Joe Schmo, that's exactly what I was whenever I started doing this. But so who is this for? It's really for anyone that has any sort of disposable income. If you're living paycheck to paycheck and you're just not getting ahead,
mm-hmm.
and you don't have any pool of resources to access or anything like that, it's probably not going to be a good fit for you.
Mm-hmm.
But what we find often is sort of your typical household is someone who, they might be saving $400 to $500 a month,
mm-hmm.
that they're just socking away in a savings account for
mm-hmm.
emergencies or something like that. And they also have some debt that they're trying to pay extra on to get
mm-hmm.
out from under.
Mm-hmm.
So they might be making $500 a month in extra payments to those banks.
Mm-hmm.
Well, anything over and above the minimum is money that they are sending out the door to never return again. So if we've got somebody who's saving $500 a month and they're also overpaying their debt by $500 a month, well, that's potentially $1,000 a month that they could actually start funding their banking system with. So if somebody's got money that's just sitting in savings, Andrew, you mentioned this earlier, because of inflation, money that's sitting in savings is just going backwards.
Mm-hmm.
I mean, you're losing buying power
quickly right now
every
too.
day. Absolutely. You're losing buying power every day. So if money is just sitting in savings, it's not creating any value for you whatsoever, why not put it into a better environment?
Yeah.
One of the comparisons that people make with infinite banking is not an investment strategy. It's a cash flow strategy that can include in investing and all these other things. So it's often referred to as the and asset. It's something that can be paired up with what you're already doing. But this idea that we can take an approach to looking at your situation and actually creating more efficiency for you than you would have otherwise is something that really, it kind of blows people's minds. We've had clients who were following the Dave Ramsey thing, doing the baby steps.
Mm-hmm.
And we just showed them how to blow through those baby steps, like at an unbelievable rate. Like they had no clue what they were capable of, because no one had ever evaluated their situation from a perspective of infinite banking and showed them how to actually start controlling the banking function.
It's almost like this is playing offense versus defense. And
Yes.
and defense isn't necessarily a bad thing, but it might just be a little bit slower, take a little more time, be a little bit arduous. You talked about having some money set aside as well as some money to invest. So what would be kind of like your minimum barrier of entry to really be able to start leveraging this? And then how much money would you say is wise to be able to put back into that to allow yourself that continued flexibility and freedom financially?
So we have clients from all different sides of the spectrum. We have some clients who put 6 figures a year into a policy.
Mm-hmm.
We have some clients who put 500 a month into a policy. 500 a month is probably about the sweet spot in terms of having some disposable income that you can actually put into a system that you can start taking advantage of. So I would say probably the minimum is going to be around 500 a month that you can start funding a policy with and really start to see the efficiency of your cash value pretty quickly.
Mm-hmm.
Can you talk about kind of the mechanics of how that works? And maybe I really like the example of trying to pay off debt. Let's say you have some debt that you're trying to pay down. Traditionally we might see a Dave Ramsey approach of just paying everything towards that debt. But can you walk through, like, what does that look like with an IBC, an infinite banking concept based, dividend structured whole life insurance policy structured for cash value? How do we take advantage of that to pay off debt, for example?
So that example I used earlier about somebody who had $1,000 a month, that 500 of that was going to overpayments, 500 of that was just going to savings. So we could take that $1,000 a month, start a policy with it, and immediately within the first month start borrowing against the cash value to start making those overpayments to chunk down and pay off that debt.
So walk through this a little bit with me. So if you're borrowing against your policy, so correct me if I'm wrong, that is the insurance company's money that you're getting. It's not coming out of your policy. So you're taking a loan, technically speaking, from the insurance company. You still have to pay that loan back. So what's the math look like in terms of, hey, I'm borrowing from somebody else to pay off a borrow from someone else?
Well, technically you don't have to pay it back. Remember, the death benefit is the ultimate collateral. But being a good banker, once we get that debt paid off, now we're going to take those payments that were going out the door to someone else, and we're going to start sending those back to our own banking system, because money has to flow no matter what. So if we get a debt paid off, if we don't have a plan for it, then it's going to be spent and we don't even know what we're going to spend it on. It's just going to be absorbed into our budget and all of a sudden it's gone. And we're like, oh, well that money's gone. So it takes some discipline to practice the concept of infinite banking. It doesn't take a massive amount of discipline, but it does take some discipline. I think part of the value in having a coach, a resource, someone you can reach out to, is maintaining some of that accountability with making sure that am I doing this right? Or we've had clients from time to time who called and like they're kind of embarrassed. They're like, you gave me this plan and I screwed it up. And you're like, hey, we've all made mistakes. Don't worry about that. Let's just take a look at where you're at right now and let's get you back on track. So we want to make sure that anything that could be sent to ourselves, to our banking system, is going to happen. If you go through life constantly making payments to someone else, you're not going to be left with very much. But if you go through life constantly making payments to yourself, you're going to be all right.
So I guess that's where my question lies, though, is if I'm paying down debt, let's say it's a car loan, right? I've got a $20,000 loan on my car. I'm paying the bank or the lender that 20 grand plus interest. To switch that into an IBC policy, if I'm borrowing against that to fund the payment of the car, let's say, I'm still paying the insurance company debt. So is it cheaper debt? Is the interest rate different? How does that advantage in my situation?
So there's a couple of different things in play there. One is there is a contractual rate of interest that you earn on the policy. And then you also have the loan rate. So no one can loan you money for free. There's always going to be a cost of capital.
Sure.
So the fact that the insurance company is allowing us to use their money, there's a cost of capital. So let's just say, for simple numbers, that the interest is 5%.
Yep.
Let's say you had, let's say you built up, or you put in a lump sum, you had $10,000 cash value sitting in your policy, and you wanted to use that towards something else, whether it be pay off debt or make a purchase or invest or whatever. It doesn't really matter. So you take that policy loan, the interest is simple interest, and it's prepaid up front. So if I took a $10,000 policy loan, they're going to send me $9,500. They're going to hold back $500. And that is my cost of capital with the insurance company. Now, if I pay that loan off in 12 months, then my total cost of capital was that $500. Mm-hmm. If I pay it off in 6 months, they're going to credit half of that interest back to me. Now, the other half would go to the insurance company. But the reason that doesn't matter to me personally is because as a customer of the company, I get to participate in the profitability of that company each year through dividends. Mm-hmm. So I'm very interested in the company maintaining their bottom line. Just like if you owned a dividend stock, you want that company to be as profitable as it possibly can. So mm-hmm. It's the same way. So I'm not concerned about any amount of interest that I'm paying to the insurance company. Now, that's just how the interest portion works. What you also have to remember is there's a contractual rate of growth that happens daily on that cash value. So even if we're talking about simple interest of 5%, it's nowhere close to 5%. And as time goes on, you're actually going to get on the positive side of the interest altogether. So is it
the comparison of simple versus compound interest?
Exactly.
That's okay.
Yeah.
Okay.
So there's an example that I use in the course, and I've been using this for several years, and it helps to kind of wrap people's mind around this idea of leverage and what that looks like. So let's say you saved up $30,000 for a brand new vehicle. You call me up, you're like, Nate, got 30 grand, got my car picked out, fixing to go down dealership, pick it up. I'm like, hey, I'm so glad you did that, but don't go straight to the dealership just yet. This is what I want you to do. I want you to go down to your local bank, drop that $30,000 into a CD, certificate of deposit. And let's say for this example, the CD is going to pay you 4% interest. And then what I would tell you to do is turn right back around at the same bank, borrow $30,000 from the bank using your CD as collateral, collateralized loan. That's the safest loan that anybody can make because they already hold the asset. So in that example, they're going to pay me 4% on the CD. Let's say they're going to charge me 6% on the loan. These numbers sound completely backwards, but just stay with me. Let's amortize this out over 48 months. So let's say for the next 4 years, I'm going to have a monthly payment. 30,000 at 6% is $704.55. So for the next 4 years, I'm going to pay $704.55 to the bank. After 4 years of making those payments to the bank, I would have paid the bank a total of $33,818, which means I would have paid $3,818 in interest. But remember, I was using my CD as collateral, mm-hmm. and my CD was compounding that entire time. Mm-hmm. My CD is now worth $35,096. So I paid $3,818, but I earned $5,096 at the same time, which means I ended up on the positive side of interest altogether. Mm-hmm. And that is, people ask, how is that possible? And it's simply because the CD is compounding on an increasing number. The loan's going off of a decreasing number. So at some point they cross, the CD keeps going up, the loan keeps going down.
Right.
Well, it's the same concept when you're borrowing against your policy. Yeah. You've got uninterrupted compounding interest that's working in your favor the entire time.
So that's a powerful example that shows how you can come out ahead with just one. I mean, that's one loan, right? We take how many loans over the course of our life? How many times are we buying a car? Or
just one car. I mean, imagine if you started doing that with everything in your life, how fast would your money grow? Right. See, we're not taught how to earn interest on our expenses. We're taught how to earn interest on our investments.
Yeah. Mm-hmm. Yeah.
What if your expenses could be fuel for your asset column?
Mm-hmm. Mm-hmm. So,
and that's where I think it can get really interesting, because to me, on paper, right, using the idea of other people's money to pay off loans or debts that you have against your policy, that seems like the superpower. If you can do that more, you're going to get way ahead. But it sounds like you can still do that with liabilities in this system as well. And that's really interesting.
Well, you think about this, most people pay their car insurance monthly, right? Most people do.
Yeah.
Most people pay their car insurance monthly.
Yeah.
Unless you're retired. Retired people like to pay it annually and be done with it. But most people pay it monthly.
I love seeing that discount, so I pay mine annually.
Right.
So most car insurance companies, they'll offer 10 to 20% discount for paying it in full.
Yeah.
So if you had that money sitting in your policy, that's an automatic 10 to 20% return on your money, just like that.
Yep.
And then you act like you're the monthly, or you act like you're still paying the insurance company monthly, and you just start sending that back to your policy. Get ready for next year.
Is that kind of the approach that you teach? Is turn as many of your expenses into this banking system as you can? I mean, I've heard of people paying rent and things like that with an IBC policy. Is that your approach?
It's not going to happen overnight, but the goal is to get to the point where everything that we do is running through our banking system and not somebody else's.
Yeah.
Inside of our course, there's actually a little image or PDF, whatever you want to call it, called the IBC Memory Jogger. And it's sort of a mind map, and it shows you all sorts of examples of things that you could potentially be doing to utilize your infinite banking system in a more powerful way.
Now, not to be Debbie Downer here, but one of the other, I guess, financial strategies to consider is digital currency and doing the whole Bitcoin thing to leverage against, many different things. Because we're still using, federal money, or we're still using money, I should say, or tender. What are there any concerns in that regard? Just with us printing money and the challenges that we may face that we might not see today. What are maybe some future challenges that we may be presented with this method, kind of all things considered over the last couple of years?
Well, the life insurance industry as a whole is probably one of the most stable industries in our nation's history and one of the most profitable. So they are long-term thinkers on a level that we can't even conceive. Their actuaries, their mathematicians, all that stuff, they take massive amounts of data into consideration. And if we ended up seeing a shift to digital currency, they would evolve, they would adapt to whatever that is. You mentioned Bitcoin earlier. Some people are like, hey, I would rather buy Bitcoin than put it into a whole life insurance policy. Well, why don't you do both? Why wouldn't you want to do both? Because the thing about Bitcoin is you can borrow against it, but there's still a lot of volatility right now with that. There's not any volatility with whole life. So what if I could build up cash value inside my policy, and then when I see dips in Bitcoin that are attractive, I can take a policy loan against that and go buy Bitcoin. Now I've got minimum guarantees on my money no matter what, and I'm also holding another asset. Now I've created equity in two different assets with the same dollar. I mean, you think about real estate, you think about stocks, whatever the case may be, whatever those assets are or investments are that are attractive to you, we still do a lot of that stuff. We just run it through the lens of infinite banking now, and now we're getting multiple uses for our money.
Now, here's a question. Would you still have term insurance and use the infinite banking to pay your term insurance? Because we know we can get way more amount in a term policy for way cheaper. So is that a potential strategy that people have used where, maybe they're getting $1 million or $500,000 term policy for a couple $100 a month versus, but then also kind of executing this strategy, the IBC strategy as well?
So, yes, there are there's times where we're solving for death benefit where somebody wants to actually borrow against their cash value to cover a term policy for additional death benefit that they need, something like that. So that is possible. Something else that many people don't realize is that your death benefit on an infinite banking plan is not a fixed death benefit. It's an increasing death benefit year over year. So eventually you'll get to the point where you've got so much life insurance, you don't even need term insurance anymore.
Because it's compounding over time as well at guaranteed percentages.
Nelson said that if you solve for your need for finance using infinite banking, you're going to end up with more death benefit coverage than insurance company will even allow you to have.
Mm-hmm. So can we walk through this thing? I mean, so I come to you and I go, hey, I'm married, got a couple kids, have a stable job, I have some passive income or not passive income, but some extra money that I could spend, and I want it to work for me. I have, funny enough, $500 a month that I can fund this policy, and I have maybe $10,000 to start something, or as kind of like I could either let it sit in the bank, as you mentioned, or I could start getting it to work for me. So that's kind of who I am or what I got. What would you suggest for that individual?
So we're going to look at your cash flow, resources, debt, all that stuff.
Mm-hmm.
We're going to evaluate that. We actually have some proprietary software that we can use to show you hypothetical scenarios on what it would look like if you implemented this in your life.
Mm-hmm.
So we're able to take it from the theoretical of, oh, this is a cool idea, to the reality of, okay, this is what I could expect at a minimum if I actually started doing this.
Mm-hmm.
And so people can actually see that for themselves and determine if it's going to create the value that they're looking for. If it is, that's great. We're happy to come alongside them and work with them and get that started. But if for some reason they don't see the value in it, that's okay too. We can stay friends.
Mm-hmm.
But for someone like that, we're going to look at a combination of the two things. We're going to look at the lump sum and take that into consideration, and also the cash flow. We don't want to design something that's too small that doesn't really create the momentum that you need.
Right.
We also don't want to create something that's too big that's just not going to be sustainable. We want to find really that sweet spot that creates the most efficiency for you, but it's also something that's just going to fit into what you're already doing.
Mm-hmm.
Yeah, that kind of pairs with one of the questions I was going to ask is what happens if you have a life circumstance that changes? Like you set up a policy, you're saying, hey, I need to contribute $500 a month, but all of a sudden I lose a job or something happens and I don't have access to that $500 a month. What do you do in that situation? So
we've only come across this one time so far with a client. This was right around COVID, and she was fresh out of college, and she had been funding her policy for maybe like 6 or 8 months. And then all of a sudden COVID hit. And with the company that she was working for, because she was the newest hire, she was the first one to go. Mm-hmm. So all of a sudden she's like, oh no, what do I do? Well, for her, the cash value that she built up inside the policy could actually be used to cover the premiums until she got back on her feet a little bit. So that was good for her. Yeah, it worked out where it didn't necessarily put a ton of stress on how am I going to do this now. Mm-hmm. But if someone gets to a place where they just cannot afford it for whatever reason, just everything goes south. In that situation, then the policy would just cancel, and any cash value that was available would just be sent back to the customer.
Okay. So one of the hopefully obvious perks here, if you're going to play banker or be your own bank, having access to as much capital as you can seems like the obvious play there. You want to be a bank that has money to go put to work. So is that kind of the approach? Well, you mentioned the importance of finding that sweet
sustainability.
Spot. Yeah, right. It's not stressing you out, but you also, correct me if I'm wrong, want to put as much as you can comfortably put into a policy to then start taking these loans. Am I on the right track there?
Absolutely. And one of the aspects of infinite banking that gets overlooked a lot of times is just what it looks like if I become the bank for myself and I become the bank for my family. And me and Brandon had this epiphany the other day as we were talking, and we realized that if all we ever did, if we never invested another dime in another asset and another, real estate, none of that, and all we ever did was just became the bank for ourselves and became the bank for our families, we would automatically be better off than 95% of people just by doing that alone. And it becomes really powerful when you start to think about the family banking aspect of it, because I've got 4 kids, and my youngest daughter's 9, my oldest daughter's 12, my oldest son is 18, my youngest son's 15. They're all about 3 years apart. in the next 10 to 15 years, there's a good possibility that all of them are going to be married, which means if we're looking at a family tree, me and my wife at the top, and then 10 to 15 years down the road, I got 8 people underneath me. If there's no system in place, that means all the payments and interest that they're using to fund their lives are going out the door to Chase, Bank of America, Capital One, Wells Fargo. If there's a system in place and I am the family bank, they can fund their life. They can stay away from the banks. They can pay me. I can earn passive income from them. And they can fuel their inheritance for the future, because eventually it's got to come to them.
It's theirs, right?
I was going to
It's
say,
theirs.
what does that look like down the road? Can you pass
So
these
money-
policies down?
Yeah, money goes back up to the top, and then it cycles within the family. And the more times you can get money to cycle within the family, the stronger that money becomes. The problem is,
you're extending that compounding year.
absolutely,
that becomes huge.
Right.
absolutely.
What is the process of that? So if someone passes away, obviously you've got a cash value death benefit that's going to your beneficiaries. Can they take that and then create an IBC policy from that as well?
Absolutely. Okay. So the beneficiary is going to receive the death benefit payout tax-free, because life insurance tax-free, death benefit. And then they can decide what they want to do with that. If the education has been passed on and passed down, then they're going to go out and start creating their own family bank. Now that idea that I gave you earlier, or that example about how banks make money, the 5% and 10%, couldn't I, in effect, loan my kids money at 10% interest? If they understand that they're not having to jump through hoops with the bank in order to obtain it, and it's fueling their inheritance for the future, they know that they're getting it back one day in multiples. So I can charge myself 10%, charge my kids 10% interest, and still help them, and help myself simultaneously, because I'm getting passive income. I'm getting cash flow monthly from the payments that they would have been making to the bank.
And in theory, if they don't pay you back, then nothing still happens. You just don't get to grow it, but not making that payment back on the policy would theoretically be okay. Not that you would want that to happen, but if some emergency were to take place, and this is early on in that process or whatever, then there's kind of like a fail safe in that way. It sounds like, potentially, not that you would want that to happen, but
yeah, I mean, hopefully all my kids are going to be a good banker and be good bankers and make their 100%. Payments back. But if they borrow money out and they don't pay it back, we'll just go and amend my will, to make sure that they understand what that what that looks like long term.
So
I'm just playing.
So in addition to becoming a bank for yourself, for your family, what are some other things that you found some of the successful folks that you work with invest in and use that self bank for? Is it for buying a house? Is it for building a house, buying land? I know those seem to be some reasonable things. I know for me, something that I'm interested in is purchasing heavy equipment and then either renting out heavy equipment or finding operators to operate that.
There is an example in the book you need to go look at.
Okay.
The equipment finance example in the book, page 54.
I'm on the right track. Yeah.
Page 54. Yeah. Go check that out.
Okay.
So you mentioned land. I actually used my policy to buy land in 2020. Me and my wife were looking for about 10 acres of land. And we had some friends that were selling some land, but they were selling a little bit more than 10 acres. They had a 23-acre spot of land. And we went and looked at it and really fell in love with the property. And we're like, yeah, let's do it. So I borrowed the down payment from my policy to secure the land, to secure the deal. And then I've just been making payments on it and shifting more and more of that wind current over time. But what's crazy is the value of that land is now double what I paid for in 2 years.
Yeah.
It actually, what land is going for in this area, as far as what's listed on realtor.com, is more than double what I paid for my land. I actually got an offer for my land yesterday. Somebody's trying to buy it from me, and I still haven't decided if I'm gonna sell it or not. And so if I end up selling it for that price that they've offered me, because I have very little of my own money in the deal, I've been using the insurance company's money.
Yeah.
I'm going to 10 to 20x my money if I sell it.
Yeah.
So, there's all kinds of possibilities, but with real estate, we have clients who are real estate investors, like heavy real estate investors, and they will borrow money against their policy to go secure a real estate deal. And now they've taken that equity, and now they have basically multiplied that equity in a sense. And now they've got equity in two different assets with the same dollar that they put into the policy to begin with.
Right. Yeah. So let me ask this. Sorry, go ahead.
Oh, I was just going to say, the cash flow coming off of that real estate deal can now be sent straight back to the policy. And now you've got assets paying for assets, and it just becomes a machine.
So is it kind of, this is then the idea that say you're going to buy, a $400,000 home and you have 80K because you want to get 20% down, rather than putting that 80K down, the suggestion then would be to open or begin a policy or a product to where you put the 80K in, and then you're borrowing the 80K from yourself to then pay for the down payment on the house. Is that kind of, am I understanding that correctly?
It's possible. It really just depends, because the insurance company has limitations on how much they will allow you to start a policy with. Because if you only make 50 grand a year or something like that, they're not likely to give you an $80,000 annual premium, because they're going to look at that and go, well, they're not going to be able to sustain this. So they're also going to look at your human life value, and human life value is determined by how much your income is times your working years that you have left.
Sure.
So if you made $100,000 and you've got 25 years left to work, well, so you got your human life value is 2.5 million in death benefit. So that's the most that they're going to allow you to have in death benefit if that is your current situation. So it's possible to do something like that. But it also depends on the individual and what they're, if they're making $300 or $400 grand a year, then yeah, the insurance company will probably let them do an $80,000 policy.
Is it possible? Like, let's say you get an inheritance or some lump sum of money. Can you take that and start a policy, but then fund it with let's say, $1,000 a month or whatever your available income allows for you? Can you have a lump sum plus monthly payments?
You can, but it also depends on what that lump sum is. So, because there's rules that we have to follow, there's what's called the modified endowment contract, or the MEC line. And what that essentially means is the IRS set up rules in 1988 that said, if this life insurance policy violates these rules, it becomes a taxable event. And so we structured in a way to make sure that it doesn't become a taxable event.
Got it.
Okay.
So maybe you would take part of that lump sum,
right,
create your policy, keep funding it. And could you, theoretically, I guess you could take the lump sum and divide it into the policy over time, perhaps?
You could.
Okay.
Yep. Yeah. We've had a client who had about 300 grand sitting, and we were able to do a $100,000 policy for them. The insurance company wouldn't take 300 grand, but they would take 100 grand. And so we just dispersed that in over a 3-year period.
Yeah.
Actually, in that case, we did a backdated strategy where they were actually able to get the money into the policy. They were able to put 3 premiums in within 18 months.
Okay. When you mentioned cash is available, or a policy loan is available within the first month, is that correct?
That's right.
Okay. And how much of your, let's say, what percentage of your policy could you borrow against?
Well, there's 2 aspects of your policy. You've got the base premium, and then you have the paid up additions rider.
Okay.
Your base premium is the foundation for your entire system. Your base premium is what ultimately determines how much you're going to be able to fund your policy with in the future, your ability to fund it in the future. So it's important to have a good base premium, but your base premium is your long-term benefit. That's where your dividends are going to be paid off of in the future. Your cash value, the paid up additions portion of the policy that you fund, is your short-term benefit. That's where you get access to cash value up front right out of the gate.
Mm-hmm.
Your base premium is not going to produce any cash value that you have access to until after the first 12 months. And then it actually starts producing cash value from there. So the reason why Nelson says you got to be willing to think long-term is because whatever money goes into the base in the first year, you're not going to be able to access that. You're going to be able to access everything over and above that.
Yeah.
Yeah. There's usually like a flipping point, isn't there? When a larger percentage of the cash value becomes available after a period of years, usually.
It's usually about year 4, year 5, where you get to the point where you now have dollar for dollar access to everything you're putting in.
Mm-hmm.
Right. Yeah. So again, the importance of thinking long-term, and this is not a quick fix. This is not a get-rich-quick scheme. It's a long-term bank that you can set up for your family. And I'm kind of curious on that note, as a dad, what concepts are you teaching your kids about this infinite banking system and how this works? How do you explain it to them?
Well, my oldest son has been more inquisitive than the other ones. So we've got some basic money principles and things like that we're working on the other kids with. My oldest son is the one who's really started asking questions and things like that. And so they understand that we don't operate the way everybody else operates. They don't fully grasp what that means. And quite honestly, most adults don't grasp what that means, which ironically, the title of our educational course that we created in 2019, we named it Holy Shift. I have to pronounce that correctly to make sure everybody hears that. And the reason for that, one, is kind of get your attention, but also it requires a righteous shift in your behavior and your thinking, because we're not doing things the way everybody else is doing them anymore. Yeah. And so the most important thing my kids understand is we don't do things that everybody else does. We're observing what everybody else is doing, and we're kind of doing the opposite in most cases.
Yeah. Yeah.
Yeah.
Go ahead, Andrew.
I mean, that's a phrase you often hear with investing, right? If you're trying to build wealth for you and your family, you probably don't want to do what everyone else is doing, right? If you're following the crowd, well, good luck and enjoy the typically pretty small yields that might occur there from traditional methods. So as we think long-term and kind of looking towards retirement, let's say, we've talked about how these policies can spit out a dividend, an annual dividend that comes from, correct me if I'm wrong, but my understanding is as you fund or as you're paying your premiums, right, the insurance company and their actuaries have gone through and figured out, okay, we expect, not to be, what's the word, morbid, but, we expect this many people to die every year. And if not that many people die, there's extra money that becomes a dividend. That's kind of the basis for the dividend, right? Is over and above it. You overpay a policy expecting that this large pool of people within a life insurance, group, there's a certain number that will pass away in a year. And if they don't, then the extra money is redistributed to the holders.
Well, you also have to think about the other ways that they are growing their bottom line. So they have assets and things like that they invest in. So the simplest way to understand what a dividend is, it is an overestimation of the operating costs of the company, and an underestimation of the performance of your assets.
Mm-hmm.
So then we have that dividend that gets spit out every year. And then over the course of long term, right, if we're thinking long term with this, 40 years plus, your policy has presumably built up quite a bit of cash value. That, whatever, is it kind of 3 to 5% is the range I've heard for a dividend? Is that somewhere in the
Yeah, that's probably about right. I think right now with our current, I think it's around 5%, something like that.
So where I'm going with that is, is there a way to approach that almost like a retirement account where the dividend then becomes something you could live off if the cash value is high enough in those retirement years?
You definitely can. One thing that we point out to customers and clients is most people in their lifetime are only ever going to earn interest off maybe 5 to 10% of their income. And that's about it. Because that's what they're saving That's all they're putting away, and that's all they're investing is about 5 to 10% of their total income. If you're able to earn interest off 100% of your income, no matter what that interest is, and you're still able to go out and use it for everything else you need in life, you become exponentially stronger. There's no real way to even quantify what that is. I just know it's good. And so the goal with infinite banking, as I mentioned earlier, we want to run as much of our money as we possibly can through our system and ultimately become the bank for everything that we do. So the goal with infinite banking is to get to the point where your premium is equal to your income or your income is equal to your premium, however you want to look at it. It doesn't happen overnight, and we don't pressure people to do that, but you're working towards that more and more, because as time goes on, every dollar you put in there is creating more opportunity than you would have in any other situation.
It's like it's the compounding effect, but with all these other areas, not just a retirement account. It's you're compounding everything that you're putting into it.
Yeah. So
sorry, I keep stepping on your toes there, Levi.
They hurt. Ow.
One of the things I've kind of heard, again, I've read a little bit about this and experimented. Experiment is not the right word, but kind of asked some questions of people doing this. And one of the things I hear a lot is people setting up multiple policies with this IBC. What is the advantage of having more than one policy? Because I've heard of people having 20 plus policies, and I don't understand that. So can you explain that to me, Nate?
So Nelson Nash, and I think he talks about this in the book. He saw a policy like a business, and it's a banking business. So the example that I use with clients sometimes is, imagine you move into a big town and they don't have a Chick-fil-A, and you're looking around thinking, man, if I start a Chick-fil-A in this town, it's game over. Yeah. I'm set. So you find a good spot on the north side of town, you start a Chick-fil-A. Sure enough, it starts humming exactly like you thought. And after a while, you're looking around thinking, man, I got to do this again. So you could potentially take some of the profits from the first location that you started and go start a second location. Well, now you've offset some of your costs, because anytime we start a business, the biggest cost that we incur is right up front, because we haven't made a profit yet. But over time, we start to make profits, and then things become more efficient. So now I'm going to go start a south side location, and then that one starts humming. And now I'm going to start one on the east side of town, the west side of town. I want as many Chick-fil-A franchises as I can possibly afford, because they're all so profitable. And this is why Nelson Nash, at one time in his life, he owned 49 different policies. Ooh. Because he believed, as I said earlier, that, his policy was like a business. And he also believed that as long as he was willing to put something into it, it was going to pay him the rest of his life. So he saw his system of policies like a franchise owner of a business. Having multiple policies is really a couple of different things. One, you make it to a point, and this kind of happened with us in a few different ways, personally and within our business. We actually have 6 policies in our business that we run our revenue through. The reason we have 6 is because we started with a small one, because that was all we could afford when we first started. But as our revenue grew, we had a need for a place for more capital to reside. Well, that policy was only so big because we started with what we could afford at that time. So over time, we have found a need for more and more policies to run more and more of our revenue through. And we have to wait until we file our taxes every year so we can show the insurance company that we're worth more money, so that we can get bigger policies. So by the end of this year, we'll have 8 policies that we're running our revenue through.
That makes sense. Yeah.
What is the biggest hurdle you tend to face? Like, you got people that are interested, they're curious. What seems to be one of the biggest hurdles, or maybe even one of the biggest misconceptions of this? Because it seems like a no-brainer, right? So what is that? What is people's hesitation towards this?
I think just the foreign nature of it in general is really hard, because I was 35 years old when I learned about this. So to think for 35 years of my life,
like
for 35 years of my life, I mean, Nelson Nash wrote the book in the year 2000.
Mm-hmm.
Okay. So I read the book in 2017. So you're telling me for 17 years, this was out there and I still hadn't heard about it,
Mm-hmm.
Yeah. So I think that's one aspect of it. The other is really just the conventional wisdom that's put out there consistently with, the Dave Ramsey's, the Susie Ormans of the world.
Mm-hmm.
Those that have been given a mainstream platform have been telling everybody for 25, 30 years, stay away from whole life insurance.
Yeah,
exactly.
Buy term, invest the difference. Yeah.
So, it's really just that conventional wisdom that we kind of fight against a little bit. And also the concept of being able to grow my money outside of a bank and outside of Wall Street doesn't make sense if you don't investigate it.
Right.
So
and it's not common knowledge. This is not in school. This is not, yeah.
Herbert Spencer, I'm paraphrasing here, but Herbert Spencer said the downfall of mankind, for the most part, is contempt prior to investigation. Mm-hmm. And, that's what a lot of people that I come across, like on Twitter and Instagram and stuff like that, they hear whole life insurance and they just start hating.
Yeah.
They haven't done any research.
Mm-hmm.
They haven't gone deep into our educational process, but they just go, no, there's no way.
Why do you think it took so long because, whole life has been around for a long time. So why do you think it took so long for someone to figure this out? Because it seems like this game has been able to be played for a long time, but it's just now kind of picking up steam, and it's in popularity. It's almost like the UFC, right? Where it's it could be growing at an exponential rate here. So what do you think that delay was? And what's kind of been that change?
I'm going to show you something. You may have seen this before, but I guarantee you somebody watching this right now has never seen this. Have you ever seen this logo?
Oh yeah, with the arrow between the E and the X, and you can never not see it again.
Most people have no idea that arrow is in between the E and the X.
I just poisoned everyone who is watching this.
I didn't know that.
Oh man, come on.
So there's an arrow between the E and the X, and it's been there the whole time. And Andrew, you just saw it for the first time.
So for those of you listening, he's holding up a logo for FedEx.
Yeah.
And if you're listening, go check out the YouTube video of this. We'll have that up.
Yeah.
I've never seen that before.
So that arrow's been there the entire time, and most people don't see it. Yeah. Nelson Nash, the whole, like, all the characteristics of whole life insurance have been the same this entire time. Nelson was the only one who finally discovered, oh, there's an arrow there.
Yeah.
There's something there that's been there the entire time, but most people just miss it.
Yeah.
And so with that, the way Nelson Nash discovered that this was possible, and Andrew, you're probably familiar with this story, is in the 80s, Nelson was doing some real estate deals and stuff like that. And within a very short period of time, interest rates went through the roof. And all of a sudden, he was faced with 23% interest on $500,000. That's like 60 to 70 grand in interest a year. Just interest.
Rough.
And he said that the solution to his problem came at 2 and 3 in the morning on his knees in prayer. And he said, when he tells his story, he said, it was like a baseball bat across my forehead. And God just said, you've got everything you need right in front of you. Because Nelson, at 13 years old, Nelson bought his first whole life insurance policy. Nelson was a huge believer in whole life insurance at a very young age, because what most people don't realize is before the stock market got really sexy, people saved money in banks and whole life insurance.
Yeah.
That was where they put it. And it wasn't until the 60s and 70s when people started getting crazy returns in the market that people started looking at their whole life insurance policies and go, well, I can do way better. If I'm earning what I'm earning inside of a whole life policy. My neighbor walks over and goes, dude, I'm getting like 20, 30% in the market right now. Well, now a whole life insurance policy is not looking so hot.
Sure.
Now there was mass marketing that also went into that convinced people that whole life insurance was terrible, and people started diverting funds elsewhere.
And is there, to ask one more uncomfortable question, is there any truth to that, or is that propaganda? Is that silliness, or is an ill-used whole life policy maybe not as favorable? Like, is that on the table, or it was just ill-used, and it's not the policy's fault, it's the way it was or wasn't used, perhaps?
So here's where a lot of people get hung up. Whole life insurance is if we're just talking about whole life insurance and not infinite banking, whole life insurance by itself is a very long-term savings strategy. We live in a culture today that has this microwave mentality that has to have it all right now. And most people can't think long-term. So this idea of having a place to put money and everything like that, and thinking long-term and everything like that, well, people who have acquired wealth and built things for themselves, they have the ability to think long-term. They know how to keep money. They know how to grow money. Most successful people that I come across that I start working with already have whole life insurance. They were just never taught how to be their own bank with it. So if you just take infinite banking off the table for a second and you just look at whole life insurance by itself, if it really was the worst place in the world to put your money, it would have been a dead product 200 years ago.
Sure.
But there have been people who have found value in it for a very long period of time. But then you add in the function of banking and all things you can do with it, and it becomes the Hulk. I mean, like also it's just a regular guy, and now he's got muscles and can tear through things, whatever. That's if all you ever did was put money into a whole life insurance policy, you never did anything else. And we're not talking about infinite banking. I'm just saying long-term savings. You're going to have a savings account on steroids.
Yeah.
Okay. But savings accounts are not where people make wealth. People make wealth in investing.
Right.
So, but you can invest in yourself by becoming your own banker.
Yeah.
And that seems like, I mean, that's a great note to kind of maybe highlight the importance of, this is not just you don't just go out and buy a whole life policy and start doing this. It's a properly structured whole life policy to maximize cash value. And that's where somebody like you comes in and says, hey, I can walk you through the steps of how to structure that to make sure that you can get cash value out of that and start using that to generate, more assets and things like that. So Nate, I want to make sure to pass this off to you to let people know, what are you working on right now? Where can people find you and learn more about what you're doing? And if they are interested in working with you, how do they find you and do that?
So we are launching an updated educational course for infinite banking that's coming out just in a few days. So by the time somebody listens to this, you'll be able to go in and check it out, access it, and doing something special for anybody who's listening. You will use the discount code MOVE101, MOVE101, and you get free access to the course. So you can go in and check it out and see it for yourself. What I tell people is, going through this educational process, the worst case scenario is you're going to learn something new. That's the worst case scenario. The best case scenario is it's going to change your life the way it did ours. That's not a bad proposition.
Yeah, we like those odds.
So the best place to find me, we built our business on Twitter. So my personal Twitter account is Chronicles Nate. I'm Nate, the Infinite Banking Coach on Twitter. So my handle is Chronicles Nate. We also have our Instagram page, which is ULC Money. The name of my company is Unlimited Life Concepts. So our Instagram handle is ULC Money. Those are the two easiest ways to check us out, get access to our content, things like that. And then you can go to our website, unlimitedlifeconcepts.com, and check us out there as well. But yeah, that's kind of what we're working on right now, and really excited. Oh, I've also started a TikTok channel recently, posted some videos on there. So, and that's Chronicles Nate also on TikTok.
So do you do dances on there, or is it just
Yeah.
infinite banking?
I don't. But here's one thing that I will say. If you want to go check out TikTok, go find my bucket video.
Yes,
And
yeah, I love this one.
you saw that one?
I did. That was great. I think
Okay,
that's a
cool.
perfect illustration of how this concept works. Yeah.
I've had a lot of people reach out to me and tell me, hey, that was what helped everything click. So go check out my wealth bucket video on TikTok, because like I said, I've gotten great feedback on that, and visuals are always really helpful for people.
Yeah, for sure.
Yeah, that was perfectly encapsulated how you can keep all that wealth instead of letting it leak out. So yeah, you definitely go watch that video. And Nate, this has been great. I really appreciate your time, and thanks for sharing your expertise here on infinite banking, kind of how we can use that. And I hope our listeners get as excited about this as we are. So thank you again.
Well, thank you for having me. I really enjoyed it.
Yeah, thanks, Nate. Appreciate you.
Absolutely.
Appreciate you.